Hello, I am David. Today I will tell you about weather derivatives. But before I proceed any further, let me show you the introduction video first.
The weather can drive our economy, and some businesses are now trying to protect themselves from extreme weather. Meteorologist Jeremy Nelson is here with a special report.
That's right, Terry. I visited the Chicago Mercantile Exchange recently, where investors are now taking a chance by trading weather futures and options. Games of chance. Experts say more than 60% of Americans participate in some form of gambling each year. 16% gamble regularly. Here in the Windy City at the Chicago Mercantile Exchange, there is a new kind of gamble underway. This bet involves the weather. Extreme weather events, from floods to droughts to record snow, can make or break a business. This is where weather futures and options come into play. They are investments that allow businesses and individuals to manage potential risk. Recently, the CME Group began offering futures and options trading on rainfall and snowfall for select cities. Jeff Hodgson, president of the Chicago Weather Brokerage, part of CME Group, explains that weather is a huge driver of the economy.
$2 to $3 trillion of our economic output is affected by weather.
For businesses to protect their bottom line, trading weather futures or options could be their best bet.
It is a trade. You could be a client who has a natural exposure to weather. I would go out and get the financial participants to compete for your business, in essence. Once we have a fair price or the best price possible and you believe it's a fair price, we match those trades up and then they are reported to the exchange.
Here in southeast Wisconsin, Winter Services is interested in this growing market. Owner Fritz Frazier says trading weather futures gives him an option his business needs.
I kind of call it my sleep at night policy, that, you know, I could have that policy in place or that weather future in place, and I can know if it doesn't snow, I'm going to be covered, and if it snows too much, I'm going to be covered as well.
With the change of seasons near, rainfall futures may also be attractive to any number of local investors.
You have the agriculture markets. I think you have the pest control industry. You have large golf course exposure in the Milwaukee area.
While the trades are meant to hedge risk, is this essentially gambling on the weather?
If your business is dependent upon weather, you are actually gambling by not participating in this marketplace, because your revenue is driven off of something you cannot control. So by you not participating and by not hedging this, you're actually the gambler.
Hodgson says this would also be a good option for cities. Snow budgets are fixed before the winter starts, and if a city bought a snowfall future for too much money, they would be protected and could essentially get a rebate if snow totals were above average. If not, they would lose the investment but save the money not used for clearing snow.
Okay, any local cities own these?
Well, we talked to some of the local snow removal companies. They're really looking into it, but for individual cities, we did not find any yet, but this is a growing market, and we talk more about it on our Weather Watch 12 blog. That's on WISN.com.
Back to me. First, I am going to start with the introduction of derivatives to give you an idea before go deeper to weather derivatives. Then, the impact of weather on human life and corporations. Following with the definition and information about weather derivatives, the differences between weather insurance and weather derivatives. Some history, the components of weather derivatives, the purposes of weather derivatives. Some examples of people or companies that use weather derivatives. And end with the valuation.
What is derivatives? What does it even mean?
Calm down. I am going to tell you story of my friend, Donald, the farmer. Donald the farmer who raises cows. He has 10 cows. And want to sell them in the market 1 year from now. Donald knows that he has to spend $10 per cow to raise it. Thus, the total investment will be $100. But now he is worried. If there is a mad cow disease spread to his cows, he will not be able to sell them. So, to protect his business from this risk, he meets an investor broker and enter into a business contract with him. I am the investor who also has the mutual agreement with the investment broker. And I think that mad cow disease is not likely to occur. So you tell your broker to agree to pay Donald $40 per cow, 1 year from now, irrespective of the market price. What I have just done is enter into a futures contract. Basically, Futures contract obligate the buyer to buy the asset and seller to sell the asset, at a predetermined future date and price. In this case, the future contract obligates Donald to sell 10 cows to me at $40 per cow in a year, and obligate me to buy 10 cows at $40 each. 1 year from now, whatever the market price is, Donald will get a profit of $30 for each cow. He has limited his risk by locking in his profit. Donald is playing safe, and it works off well for him. But what about me? There are two possible outcomes, which are the market prices increasing or decreasing due to the mad cow disease in the future. Let's look at the situation where mad cow disease really spread and the price drops to $20. I will have to pay $40 while the market price is $20. So in this case, I will lose $200 in total. Let's see the case when the market price is in favorable term. Let's assume that a cow is worth $100. 1 year from now, with this price I can buy cheaper by $60 per cow. Therefore, I will make a profit of $600 in total. As you can see, derivatives give you some advantage such as limited your risk or even make a profit. But, there are some drawbacks too. For example, you can lose your money from an uncertainty market in the future. So now let's start with our first topic. Weather is the most unpredictable, most problem maker to human nature. An example is like that of the human body, which is negatively affected by extremes in temperature, humidity, and wind. But that's okay since we have protections from taking meds. Let's look at how weather affects corporations and SMEs in daily life. First, impact on corporate revenue and earnings. Second, impact on decision makings. Third, increase the risks for the business. For example, farmers can be affected by weather such as reduction in the level output or seasonal products. Moreover, 1 out of 3 businesses in the world are affected by the climate change. These factors create the emergence of international weather markets as the financial tools used by companies for protection against unexpected weather conditions. Now let's look at what is weather derivative. Weather derivatives are financial instruments that can be used to reduce risk associated with adverse or unexpected weather conditions. These are some examples of the underlying assets. Sunshine precipitation, heating degree days, cooling degree days, growing degree days, maximum temperature, average temperature, snowfall precipitation. Now let's talk about how weather derivatives are different from other types of derivatives. The underlying asset such as rain temperature or snow has no direct value to price weather derivatives, so why don't we use insurance instead of derivative? This table shows the differences between weather insurance and weather derivatives. First, the events of weather insurance can be occurred in low frequency. On the other hand, weather derivatives can be happened in high frequency, while it happens in opposite way to risk occurred. Moreover, weather insurance requires the company to file a claim or prove damages just like other normal insurances, but weather derivatives does not require. Lastly, the payment of weather insurance is premium while weather derivatives pay the strike price. This is the real picture of weather derivative trading in the market. People may wonder, when did weather derivatives was introduced? It started in 1999 when Chicago Mercantile Exchange introduced the first exchange-traded weather futures contracts and options over the counter. Nowadays, there are many types of weather derivatives offering in the markets such as weather swaps, vanilla options, option collars, and exotic options. Let's look at the components of the contract terms. First, you need to know the components of weather derivatives, which consists of 7 things, which are: first, underlying asset is based on a measurable index, usually temperature or precipitation, although wind speed, snowfall and misery have been seen in the other market. Second, term of the contract period is the inception and maturity dates. Third, location is possible to base the contract on a company's business in one or several cities as long as each location is covered by a weather station. Fourth, unit size establish a dollar value per unit of weather, for example per degree or millimeter of rainfall. Fifth, limit is the total dollar extent of coverage, for example the maximum payout under the contract, which also known as notional value. Sixth, the structure of the contract such as swap, collar, straddle, put or call. 7th, trigger or strike level is the predetermined weather index level at which the contract begins to pay out. Now let's moving on to the purposes of weather derivatives. The first purpose is for financial risk management, for hedging against reduced revenues or increased costs due to weather conditions in either single cities, regions or multiple locations. Second one is for a marketing purpose, for managing the quantity and timing of demand by embedding weather hedges in targeted customer campaigns. Also it can use for enterprise risk management, creating products to hedge weather and any other market risks along with traditional insurance risks.
But who will buy weather derivatives?
Utility and energy companies can protect their volume-related revenue against cooler than average summers or unusually warm winters. In winter, such companies require protection against warmer than normal temperatures that reduce the volume of energy or product that they will sell and vice versa. Manufacturers and retailers of beverages, ice creams, heating cooling equipment and apparel can make up for reduced sales when cool summers and warm winters depress demand. Temperature is major influence on demand for soft drinks, beer and some seasonal food items such as soup. Agricultural companies can add stability to in all 4 seasons. Common temperature indices are based on variations of degree days and on absolute temperatures. Protection against excessive or insufficient seasonal precipitation is also in demand. Leisure and tourism operators whose turnover depends on the existence of favorable weather conditions can compensate for poor seasons through appropriately structured weather hedge. Operators of ski resorts and theme parks such as concerts are exposed to snowfall, precipitation and temperature. The main effects are decreased sales. Mining and construction companies can face costly delays to projects from adverse weather conditions. Excessive rainfall is a key element in determining the profitability of a heavy construction company in a given period. Insurance companies can reduce exposure to weather-related claims. Risk products tied to rainfall, for example, can provide the funds to pay flood claims. Financial institutions can incorporate these products as a way to broaden their offerings to clients, diversify portfolio risk. Now let's moving on to some basic valuation of weather derivatives. But before I proceed to the calculation, you have to know about the payoff and formula first. I bring up one of the most popular types of underlying of weather derivative, which is HDD and CDD. As you can see that the payoffs are looked similar to the simple call and put options, which base temperature expresses as the strike price, and the daily average temperature is expressed as the stock price at time t in call and put options. This table shows the example of HDD and CDD payoff according to the formula that I gave to you. Now the formula shown on the board is the basic formula of weather derivatives, and the expression of the notations are listed below the formula. Again, it looks almost the same as the formula of the simple derivatives valuation. Moreover, this formula can be adapted to use as pricing formula for both call and put option. The model that I bring up is the burn analysis method, which the formula is derived from the basic formula that I just showed to you the last picture. Though it is simple, easy and suitable in some situation, it also has some drawbacks too, such as the estimation might be unrealistic. In addition, there are also the specific type of options too, such as call and put option that I show you in this picture, which the notations are also provided.